Kenya's CFC Insurance has today reported a 23% drop in pre-tax profit, sitting at 340.75 million shillings, hit by high interest rates, inflation, and the interesting one here, an underperforming stock market. Let's bring in Steve Biko, Director at Hidalgo Group, to just explain for us that underperforming stock market. Because from where I see it, I felt the NSE has done pretty well for the last half year.
It's been one of the best performing stocks in the world. It's been voted one of the best stocks by Bloomberg. Reasons given by CFC actually leave a lot to be desired. And I think when you're looking at the numbers for CFC, I mean the drop in profits by 22.7%, the stock market's performance actually has little to do with it, especially when you're looking at the kind of market share, the kind of products and services it's doing, and in looking at its key core business in terms of insurance, whether it's direct or reinsurance aspect. So I think for me, the reason why the numbers actually doing badly, it's one, the rebranding has been done. I mean, the strategy in terms of rebranding wasn't really followed to the script.
Right.
Two, we're looking at the costs of operation, the cost of expansion of the business. And three, basically, we know that the insurance penetration in the country, Kenya alone, stands at between 9 and 11%. And so from this, you can be able to tell that very few people understand actually what CFC insurance really does.
Let's step back a moment, and the quote exactly what their statement says: these results show strong resilience in the market, characterized by an underperforming stock market, high interest rates, and inflation. So we've said the high underperforming stock market is unlikely. Let's talk about the high interest rates and inflation.
I mean, when you're looking at the numbers given out actually dispute all the reasons they're giving out. When you're looking at the issue of inflation, per se, I mean, is insurance a key component in terms of actually being able to measure when you're looking at the insurance products and services? The issue of interest rates, I might understand, because depending on how the charging of the services is done and exactly the kind of products they're doing and the claims against the services and products actually being done. So unless we understand the number of claims against them, then we can be able to tell the issue of high interest rates. But when you look at the issue of high interest rates vis-a-vis the 3.5 billion in terms of cash flow or asset base, doesn't make sense at all.
The top line appears to be quite healthy. The consolidated premium revenue, investment income, and commissions, and all these grew compared to the same period in 2011.
When you look at the asset base, the return on investment, they seem to have a lot of services not directly relating to insurance per se.
Yes.
So unless we're looking at other products in the market, real estate, investment options of the market, equity and mutual funds, then basically we can be able to look at the healthy product. I mean, it's a good brand, yes. Right. It's we're looking at its strategic regional expansion and partnership across Africa. It's very vibrant. However, the issue is just the rebrand hasn't really been done per se to be able to attract the market and also be able to reduce the issue of efficiency in terms of reducing cost management and actually looking at the loan book in terms of reducing so that they can be able to maximize on the return on asset.
CFC is now controlled by South Africa's Liberty Holdings. At the same time, it listed separately, delisted from the CFC, rather they were separated from the CFC Holdings Group and CFC Insurance listed. Has any of these affected what kind of business it is now?
In terms of what kind of business it's actually doing, no. But in terms of perception, which yes, ultimately affects its uptake in terms of getting new clients, yes, it has. And given how the delisting and the separation from original CFC Group to where it is right now has impacted because they didn't really follow the rebranding aspect. We've seen that it's been a bit trying to look for the right time to actually just be able to, its penetration into the market for people to understand it. And then also the other thing is look at the holding company. It's no longer in Kenya, it's in South Africa. So you're able to understand that in terms of actually operational costs, they're pretty high. So unless we look at the operational costs, minimize them, be efficient, they'll still keep making losses until they get this right.
That said, to their credit, they're a lot more optimistic about the second half of the year. All things remaining constant, they expect the profitability to remain stable, maybe even increase.
True. The insurance market in Kenya and East Africa has a lot of potential. The issue of investor confidence, in the issue we've seen that the regulator is actually doing a lot to be able to create awareness for this. So yes, the numbers, the book value should actually go up if they're able to tap into the opportunities, if they're able to reduce the cost. It's a good brand, and yes, they can do well.
This is a bit of an unfair comparison, but they will be compared against Pan-African Insurance, which did much better compared to these numbers we've seen.
In terms of brand perception, they're on the same level, but we need to understand that Pan-Africa or Jubilee or even CIC, for example,
we just came onto the market.
They know what they want. Even when you look at it, when you do what you call investor feedback, people know what these companies provide in terms of products and services. So people know if I'm going to Pan-Africa, I'm going to Jubilee, they know. In terms of client penetration, we can be able to tell the client leaders in terms of market share, with Jubilee actually taking the lead. So brand perception, they're on the same level, but in terms of product and service uptake, CFC is actually trailing back because they need to actually do a lot more to be able to penetrate into the market.
Let's go on a rabbit trail here for a second. The CFC's cost-to-income ratio of 60%, is this unusual?
Given the return on asset, given the cost of operation, yes.
What is a more average figure? For
them, given just looking at it, I was hopefully looking at between 38 to 42%, because one, it has a better, when you're looking at its asset and the aspect of liabilities, it has a stronger return on asset if the cost of operations can actually be worked on. So it's supposed to be better, but how the strategy is and the way forward is, most of us actually as analysts, we're trying to understand and be able to figure out exactly what their numbers are and what they're heading to.
On a more general note, what would be your brief outlook for insurance companies for the second half of the year, especially those listed ones?
Positive. We've seen that the insurance premiums have actually gone up by 19.1%. I'm hoping that this can keep going up to at least 27% by end of this year, given what the regulator and the government are trying to do in terms of creating investor confidence, and also people realizing that insurance is key for their business.
Steve, asante sana.
My pleasure.
Steve Biko, director of the Hidalgo Group, talking about CFC. Insurance is 23% dip in profitability for the first half of the year.